A critical shift is underway in global capital markets that most retail investors are completely misinterpreting. While headliners focus on short-term stock market volatility, institutional allocators are aggressively repricing geopolitical risk premiums in the Strait of Hormuz. A potential Levy on this critical energy choke point has sent crude prices upward while dragging down global indices like the S&P 500. This is not just a brief headline. It is a fundamental rewiring of structural inflation and asset insulation. But that is only part of the story. To understand how to insulate a portfolio against this macro threat, we must analyze the structural moats of global energy supermajors like ExxonMobil and Chevron. These integrated giants do not just extract crude. They control the upstream, midstream, and downstream value chains. This integration provides an extraordinary natural hedge when shipping and transport costs spike on global supply routes. Here is where the logistics sector becomes critical. Beyond energy producers, the physical flow of global trade relies heavily on logistics giants like Maersk. When strategic choke points face regulatory friction, shipping networks must immediately adapt. Maersk's unmatched scale and route optionality allow it to reroute fleets and capture elevated freight rates during periods of sudden supply chain disruption, transforming geopolitical risk into pricing power. Now look at how this operational strength translates to the financial statements. In recent quarters, ExxonMobil has demonstrated massive balance sheet strength, generating substantial free cash flow even during periods of range-bound oil prices. This resilience is anchored in low break-even production costs in the Permian Basin and Guyana. If geopolitical shocks push crude above $80, Exxon's cash flow profile shifts from stable to highly expansionary. That is not the only signal of financial health. Chevron shows a similar defensive advantage when we examine its operating cash flow margins. The company has kept capital expenditures highly disciplined, focusing capital on high-yield domestic assets. This strict capital management has allowed Chevron to maintain robust margins, offering institutional investors a highly defensive profile during times of high macroeconomic uncertainty. The next signal comes from management's capital allocation. ExxonMobil's leadership team has made it clear that they will not chase temporary price spikes with speculative drilling. Instead, they are prioritizing structural efficiency and consistent shareholder returns through buybacks and dividends. This disciplined capital allocation ensures that even if geopolitical tensions subside, the company remains highly profitable at much lower price floors. Something important is happening here with Chevron's strategy as well. Management is focusing on high-margin, low-carbon intensity barrels in their key production basins. Their corporate guidance highlights a commitment to returning excess cash to shareholders rather than investing in risky overseas assets. This defensive strategy aligns perfectly with institutional requirements for capital preservation during trade policy disruptions. To appreciate the scale of this catalyst, we must look at the broader industry context. The Strait of Hormuz handles roughly 20% of global petroleum consumption daily. Any proposed Levy or physical disruption there introduces an immediate risk premium. This structural bottleneck means alternative, geographically secure energy assets are suddenly valued at a significant premium by refiners worldwide. This geopolitical friction triggers a rapid capital rotation across the wider market. Institutional allocators are trimming exposure to risk-on equities, as tracked by the S&P 500 ETF, and redeploying capital into commodity instruments like the United States Oil Fund. This rotation reflects a growing realization that systemic inflation might remain higher for longer, altering discount rate assumptions. That leads us to a bigger question regarding terminal risk. For global conglomerates, a persistent tariff or Levy on shipping routes translates directly to supply chain cost inflation. This systemic friction can erode operating margins for consumer-facing industries and manufacturing. If energy costs rise too quickly, it risks destroying demand, ultimately cap-limiting the upside potential of the energy majors. The market appears to be pricing in another layer of vulnerability. Rhetorical threats of tariffs can trigger unpredictable retaliatory trade policies from international trading partners. This volatile policy landscape makes long-term corporate planning difficult for multinational firms. Institutional investors must closely monitor how these trade policy shifts impact both baseline import costs and international operating revenues. Looking ahead, we are anticipating a comprehensive valuation reassessment. If shipping threats and Levy proposals persist, the market will likely assign a structural premium to geographically secure energy assets. This forward earnings visibility makes select energy majors highly attractive on a relative strength basis, as their current valuations do not yet fully price in this geopolitical reality. That's where things get interesting for long-term investors. Portfolio managers are shifting focus from high-valuation growth assets toward tangible, cash-generating businesses with deep physical moats. This structural momentum in domestic energy and robust logistics networks is designed to withstand macro shocks, providing consistent yield and capital preservation throughout a volatile economic cycle. From a tactical perspective, we are placing major integrated energy producers on a breakout watch as they consolidate below overhead resistance on strong volume-backed momentum. Conversely, high-multiple growth equities and vulnerable international logistics players are entering trim consideration. During periods of global risk repricing, capital rotation toward structural value remains the most prudent play. Navigating these global macro shifts requires highly disciplined analysis. To stay ahead of institutional capital flows and protect your capital, make sure to subscribe to SR Money News. Click the notification bell to join our community of sophisticated investors, and share your perspective on the Hormuz Levy threat in the comments below. We will see you in the next analysis.